Now, Singapore's economy shrank for the first time in 3 quarters as weaker manufacturing output surprised forecasters. GDP contracted 6.8% after jumping about 15% in the prior quarter. As you know, Bloomberg partners with the FT to bring you Lex on Bloomberg, so you can get a sneak peek at the Financial Times' flagship column a day early. So joining me now live from Hong Kong is Ben McLannahan with more. And Ben, it sounds like a pretty steep drop there for Singapore GDP. What is the silver lining to this shrinkage?
Yeah, in year-on-year terms, it's a 2% fall, 2.1%, which globally isn't that bad. And relative to Singapore's history, I mean, it fell 2.4% in 2001, which is a much milder, shorter contraction. So year-on-year, it's not bad. But if you break it down and look sequentially from quarter to quarter, it's a slightly grimmer picture. From the fourth quarter 2008 to the first quarter last year, there was a 13% contraction, which was about as bad as it got for anyone worldwide. And then from the first to the second, Singapore grew by about a fifth, and from the second to the third by about 15%, as you say. And so to go from that kind of growth to a 7% contraction should be worrying for anyone connected to Singapore.
Especially at a time when the other economies of the world are recovering. Singapore often considered a bellwether for global trade. Is this a weaker export story for Singapore?
Yeah, Singapore has the highest dependence after Hong Kong of any Asian economy on exports. It's about 63% of its GDP is accounted for by exports. So that's much higher than policymakers would like. And they've been trying to rebalance like anyone else with that kind of dependency. That they're encouraging domestic consumption, even encouraging the development of casinos, which for a city-state as uptight as Singapore is quite something. But still, Prime Minister Lee last week in his unusually subdued New Year address seemed to acknowledge that the projected growth next year of 3 to 5% won't be easy to manage. And on the basis of today's numbers, it certainly won't be.
Very quickly, Ben, what is the government trying to do about it?
Well, they're trying to pull all the usual levers. They've got the very loose monetary policy, very loose fiscal policy inherited from the US. They're trying to rev up consumption, but this is a worrying contraction in exports, which for Asia's most export-dependent economy is very worrying.
All right. We thank you for your time. Ben McLannahan of the Financial Times from Hong Kong.